Hi, everyone, and welcome to the Amber Data Derivs podcast. I'm here with Antonio Juliano, who is the founder and CEO of dYdX. Antonio, how are you?
I'm great. Thanks for having me.
Yeah, absolutely. I mean, this is quite an honor. Obviously, your protocol has been one of the biggest in the space, especially for the derivative space in DeFi in general. So I'd like to maybe just touch up, do a quick brief background about yourself, how you got started and how you decided to become the founder of dYdX and where you got the idea from.
So I got into crypto back in 2015 when I got my first job out of school at Coinbase. And while I was there, it was a really great time to work in crypto because there really weren't that many legit, in my opinion, people working in crypto, but a lot of them were at Coinbase at the time. And there's been a lot of awesome people that have gone on from that era of Coinbase to do other great things like Olaf from Polychain, Fred from Paradigm, other people like that. And just learning from those people right around the time that Ethereum was invented was a real privilege. And I think it took all of us a little while to wrap our heads around what Ethereum was and what was possible with it. But after I personally did, I really had an aha moment where I felt that this was a new paradigm of computing. For the first time, you could write these programs that executed totally autonomously directly on the blockchain. And I thought there must be something that you could build with this new paradigm of computing that would be really valuable. And I've always had a dream of being an entrepreneur. So after my time at Coinbase was over, took a step back and asked myself that question: what would be valuable to build with these smart contracts? And I think smart contracts are just a fancy word for programs that run directly on the blockchain with crypto and with Ethereum. And right around then, back in 2017, when dYdX was founded, was the time when the very first decentralized exchanges were coming out. And they were just spot exchanges, though. So these are things like 0x. Back in the day, there was another one called Kyber and a couple others. And people were just starting to build these decentralized exchanges, but they didn't have a lot of usage yet. But I took a look at that and thought, wow, this actually seems like something valuable to build. It's this medium of exchange, doing this in a totally transparent, non-custodial, in a way that could eventually be controlled by its users. That seems fundamentally different and seems fundamentally valuable. Awesome. What's next? And I felt like the way finance usually evolves is you build up the levels of sophistication in a stack over time. So at the beginning, at the outset, there's a new asset or a new asset class that's created, and that's what's happened with crypto. And then after that, you start trading those assets with spot exchanges. Same thing with DeFi. And then I felt like the logical next things to build after that was margin trading in derivatives, and that was the genesis of the idea for dYdX.
Yeah, that's fantastic. So kind of starting with the sort of the evolution, kind of what you just pointed out, did dYdX first start with spot markets, or did you guys jump straight to derivatives? What was sort of the evolution in the history of where you are in the beginning all the way to V4 today?
So we started with margin trading, and specifically margin trading. We effectively built something similar to what a compound or an Aave looks like, where it was a lending pool, but we combined that with a spot exchange. And we used to use external spot exchanges. So the first integration we did was with 0x protocol. And you could basically use those two things to borrow capital, then use that capital to trade with leverage on a spot venue. And we built a really great user product around that to just do margin trading. And that was what was really big back in 2017 in crypto. That was right around the time when Bitfinex was really blowing up. It was the biggest exchange in the world by trading volume for crypto. And that was really driven by margin trading. That was really before the explosion of things like derivatives and specifically perpetuals contracts in crypto. Like BitMEX was around back then, but it wasn't nearly as big. So that's the big reason why we started with margin trading. Then around 2020 or so, we launched the very first derivatives protocol on dYdX, and that was bringing perpetuals effectively to DeFi. And nobody had done that before. And we weren't really sure if that was possible to build, but from a financial perspective, it's something that looks fairly similar to how perps operate on centralized exchanges like BitMEX, but building that into a smart contract for the first time. The first version of that we built was on layer 1 Ethereum, and I'm sure we'll dive more into that. But the next version of our perpetuals exchange after that was on layer 2 in partnership with Starkware using zero knowledge rollups, and that had been the flagship product of dYdX for a while. Fast forward to today, as probably many people know, we've built our own blockchain called the dYdX chain that's focused on trading perpetuals, and that remains the main focus today.
Yeah, that's really interesting. And I can just kind of see the evolution of like the smoothness of the trading experience. When we're talking about, doing margin on actual coins, typically, for example, in the stock market, you have to borrow shares. If you want to go short, you borrow shares and then you sell them. That's kind of that's a margin event. Otherwise, you can borrow funds against your existing collateral to lever up. That was kind of like the MakerDAO proposal with DAI. So that's always kind of heavy transaction costs and a little bit clunky. Whereas once we get into the derivative space, there's kind of this inherent built leverage, meaning that the counterparty also doesn't need to have the fully funded position, and so you can have sort of this easier access to leverage. And then you go on to Starkware, which is kind of like cheaper transactions. Everything is a lot faster and smoother, and then finally on your own app chain. So that's kind of a really interesting evolution to me. When you talk about the leverage, what is the evolution of the leverage from when you first started just doing spot on margin versus today in the perpetuals market? How much leverage can a trader actually have access to?
Yeah, so I think early on it was somewhere, I forget exactly, but on the order of like 3 or 4x leverage or so. Because as you say, the person you're borrowing from actually had the funds sitting there. So it wasn't nearly as capital efficient as trading in derivatives. Today, the maximum leverage on dYdX is 20x, which is something that's fairly standard across the crypto space for major pairs. And the reason for that is because you're just trading effectively a zero-sum contract, and both positions, the short and the long position, don't have to be fully collateralized, or at least you can take on a really high amount of leverage with them. So it is a product that, from a financial perspective, like I was mentioning, looks pretty similar to, I think, what people are used to on centralized exchanges. And that was intentional, really just trying to bring something that people are used to trading within crypto, at least, to DeFi. In a way that, from a financial perspective, looks similar, but then from a technical and from a usage perspective, has a lot of really nice properties, and that it's totally transparent. It is non-custodial. The exchange is controlled by its users, and those are all things that are fundamentally impossible on any other platform.
Yeah, absolutely. So the natural question once we start introducing leverage into the system is, how do liquidations work? How do we ensure that someone who is under collateralized doesn't, default on the counterparty and essentially create a bad trading experience?
So the really important thing with liquidations in DeFi is where are your index prices, or specifically your Oracle prices, coming from. And the way this works on dYdX is, again, similar to how it works on centralized exchanges, but with an additional layer. So the Oracle price sources are just whatever the most liquid spot venues are for the given asset. And primarily that's on centralized exchanges. Occasionally, if it's a coin that has more liquidity on decentralized exchanges, some of those will be used as index price sources as well. On the dYdX chain, how we build the oracles is actually pretty novel and interesting, in that we use the validators of the chain itself to do the Oracle price reporting. So basically every block, all of the validators will call out to the Coinbase API, Binance API, whatever, and then they'll get all the prices back. And then together they'll put all that information in a block and then come to consensus on what the Oracle price is. And this is cool because this happens on a half a second or 1 second block time latency. So it's really fast. And the other cool thing about it is it's as decentralized as the chain itself, because you have every validator that's actually doing this reporting. And there's no external dependencies. So that's all worked really well. From a margining and liquidation perspective, so diving one level deeper here, it operates fairly similarly, again, to how liquidations would work on any crypto exchange, where it's real-time margining, obviously, but whenever the Oracle price goes below or above the liquidation price for a given position, then that position will automatically enter into a liquidatable state. And the other cool thing with the dYdX chain is that this liquidation happens automatically, and it happens by the validators themselves
Mm.
on the network. So there's not really any sort of external keeper network or anything like that where the chain has to pay some amount of MEV. It just happens automatically in the node software. So at the end of every block, it'll, if the Oracle price changes for a given market, look at and find all the positions that are liquidatable for that market, and then it'll go through and attempt to liquidate them. And it'll use things like the order book. It'll potentially use things like deleveraging in the worst case, or the insurance fund, and that'll operate pretty similarly to what traders expect.
Yeah, that's really interesting. And is there like a penalty for liquidations? I know a lot of exchanges have an additional penalty, and if so, where does that penalty fee go in terms of the
Yeah,
liquidation?
so there is an additional fee right now. And as is standard on crypto exchanges, that fee goes directly to the insurance fund. So
Mm.
just in times when there's a lot of liquidations happening, then generally the insurance fund is growing, which is what you want. And that just helps secure the system in the long term.
Cool. And does the insurance fund also grow with transaction fees or only liquidation fees?
Right now, only liquidation fees.
So the idea here is that as liquidations occur, there's a insurance fund that accrues funds in case there's ever sort of a insolvency so big in the market that the liquidation isn't fast enough. Therefore, the insurance
Right.
fund stands as the backstop. Is that right?
Exactly. Yeah.
Now, a lot of CeFi
Uh,
exchanges have an additional backstop of socialized losses if the insurance fund is depleted. What kind of scenario what would you guys do in that scenario?
So that happens on dYdX as well. And this concept is generally referred to as deleveraging.
Mm.
So if there's basically no more for the given market in the insurance fund, then the deleverages will start to occur. So this is in the extreme case, but it's important to have a mechanism like this because you want some way to recover even in the worst case. So generally that'll happen against the accounts that have the highest P&L, which is the standard across the space. And is something that is again coded into the node software, so it happens automatically.
That makes sense. So if I have a big winning position and my counterparties are actually insolvent and there's no more money for me to make or more P&L to make against my counterparties, the system will automatically reduce my positions all the way down to say zero as sort of insolvency
Yeah,
occurs.
exactly. And you'll still make money in that case, right?
Mhm.
Even if you're on the winning side of a trade. But in the worst case, then you might not have made as much as you otherwise would have if the system weren't insolvent. So it is important to keep the system solvent and generally have good risk controls, which is something we pay a lot of attention to as well.
Yeah, absolutely. That's great. So one of the things about perpetuals in the space is, around funding. So how does the funding work on dYdX? Is it comparable to say Binance? And is there sort of different base rates in funding for different altcoins, or is it all sort of the same across the board? How does that mechanic work?
Right now, it's all the same across the board and works in a pretty similar way. Funding is paid on an hourly basis and then just happens based on what's the difference between the index price and the mark price, basically, which is a measure of where liquidity is being provided. So, like if the price is too high on the platform, then it's the same thing as normal. The longs will pay the shorts to incentivize more people to go short the asset, or vice versa if the price is too low.
And so the difference between the mark and the spot price accrues over an hour. And how many, like what interval, like every minute, or what's sort of the average accruals?
Yeah, I believe it's still every minute, and I believe it's kind of a random time, random sample at each minute.
Oh, okay, cool. And then at the end of the hour, it gets paid out. So theoretically, a trader can buy the perpetual at 11:59, and at noon they have to pay out or receive the funding.
Right, exactly.
Very interesting. So one of the interesting aspects about DeFi is historically, how do we get market makers into DeFi, and how do we have counterparties to take the other side of trades?
Mhm.
Because most traders are typically takers. How did dYdX solve this problem?
So this is something we focused on a lot at dYdX, and this is one of the main reasons why dYdX right now operates on an order book based architecture. So this is different than a lot of DEXs, which are AMMs. And the reason for that is because these products that are being traded on dYdX are more sophisticated, and they do require higher levels of liquidity and generally more sophisticated liquidity providers. So most of the LPs on dYdX right now are pretty much the same firms that are trading in market making on centralized exchanges, and that's intentional. So we do a good amount of efforts to make the trading experience feel pretty similar to a centralized exchange. It's just like you're placing and canceling orders on the order book. There's relatively similar latency, that amount type of stuff. So it operates pretty similarly. One of the things we are starting to explore more right now, which is very much still in the experimentation phase, is automated market makers, or vaults as they're otherwise known on dYdX. So we can dive more into that, but at a high level, that's effectively a way that can supplement liquidity that's provided by the order book with a more programmatic style of offering liquidity. And our hypothesis on this is that vaults and AMMs are really valuable for building liquidity, both on new markets and then markets that are more in the long tail rather than kind of the biggest markets in general. But that's actually become a really big focus for us on dYdX, is how can we enable the protocol to have many more types of things or number of things traded, and a big part of that is liquidity.
Yeah, so that actually brings us to V4, which is really interesting. So I always got this question a long time ago, and I still get it today with certain derivatives products. Why would someone trade on DeFi when they could trade on CeFi or a TradFi proxy? And really, I think Uniswap paved the way for that. We used to have, back in the early days, we used to have gatekeeping around, is a token going to be listed on an exchange? That created, a lot of problems for new projects. And then we had another problem of becoming an LP or a market maker was so complicated. You need a lot of infrastructure. You need a lot of systems in place. It's not an easy challenge. I think Uniswap really solved that really nicely. For the first time, anyone could list any token. And then B, it was very easy to be a market maker. You just essentially lock up some funds into an LP pool. So now my thinking is, and looking at your V4 roadmap, right now there's about, call it, over 50 assets trading, perps trading on dYdX. But if we have sort of permissionless markets, which is, I'll let you speak to that, allowing anyone to spin up any derivatives market, that's essentially like replicating that Uniswap solution. And then the LP vaults, and please elaborate on this, are essentially, passive to the LP, but there's an algorithm that will essentially balance your quotes and try to target a delta neutral positioning and just capture spreads and essentially do all the heavy lifting of market making on an order book for you. Is that right? And can you elaborate on that?
Yeah, that's basically right. And I think the comparison to Uniswap is really right as well. I really do think Uniswap paved the way for what DEXs can look like, from the sense of how many new types of assets can be traded on a decentralized exchange. Maybe just taking a step back before I dive in, I think one of the things I think about a lot as a product person in DeFi is what types of new product features and really killer features can be uniquely enabled by DeFi that centralized exchanges cannot build. And I think multiple market listings, and specifically permissionless market listings, is a really big one of those. And we saw that happen in DeFi a couple of years ago. And this is why DeFi blew up in the first place, because Uniswap allowed you to trade effectively anything that's an ERC20 token. And all these new ICO tokens, or all these just different tokenizable assets generally, started to be able to be traded on Uniswap and nowhere else. And that was a really novel thing. We're seeing exactly the same thing happen on Solana with the meme coin craze right now. And it doesn't have to be those assets specifically. I think there'll be different types of assets in the future that start to blow up as well. But fundamentally, as an exchange, especially in DeFi, you want to make sure anything, or at least the things your users want to trade, are tradable. And what's the best way to do that? Well, just allow the users to list the assets that they want to on the platform. And that's something you can fundamentally do with DeFi. This has never been done before with a derivatives exchange or protocol. and is something that we're really working on pretty actively right now on dYdX in permissionless market listings. So that's something we're really excited about. I think there's a couple different parts of that. The first part is what we've mostly been touching on in who can list the markets. And historically on a centralized exchange, well, that's whatever centralized listing team they have. Right now on the dYdX chain, it's better than that. And token governance voting is the main thing that allows assets to be listed. But can we go a step further than that and not even require any entity, centralized or decentralized, to sit in the way of you trading something? And that's what we're talking about with permissionless listings. It's as simple as sending a transaction to have a market listed. The next piece of this is how many assets can be traded on the platform. And this really comes down to two things when it's a derivatives protocol. First of all, performance of the chain or the product itself, just how much throughput can the thing support. So that's a big thing that we focus on. And the second thing for a derivatives exchange are what are the risk controls, and are these things safe to list from a risk perspective? Around that, the big thing we've been working on developing right now is isolated margin. So this effectively isolates the financial risk of every given market or any given market. Things don't have to be listed into isolated, but they could. And that basically just allows the users to list things that are much more risky, because right now the way dYdX works is everything is cross-margined, meaning that it's all the same pool of collateral. So if like one asset in the cross-margin pool blows up or has issues, then yeah, you can start getting into that deleveraging situation that we talked about before. Whereas with isolated, every risk for every market is different. So you can effectively list whatever you want, because people can look at the risk controls or the risk properties of a given market, and it's not going to affect the other things. So that's the big thing, and that's going to be shipping alongside the next version of dYdX, which is coming out in just a couple weeks. So that's exciting. And then the final thing around this is what I touched on in my previous answer, is that amazing. Now you might have more markets on the platform, and they're what your users want to trade because they're the ones sending the transactions to list the markets. But do you have liquidity on these markets? And this is one of the big reasons why, as I talked about, we've started to develop vaults and AMMs internally. And actually the first version of these is going to be shipping in the next version of dYdX as well. This is something we'll continue to iterate on over time. But I think the combination of all of these things is really exciting, because it basically starts to look a lot more like a Uniswap. And even better than that, because first of all, we can trade these things with leverage, because these are derivatives and it's more sophisticated trading. But even more exciting than that, all you need to trade a derivative is an Oracle price. With a decentralized spot exchange, you actually need the tokens to exist on the platform. So it's like you can only trade these Solana meme coins on Solana, and you can only trade the ERC20 tokens on Ethereum or an L2. Well, with dYdX going forwards, once we really start to have a lot more things available in the oracles, which is again something we're working on right now, then you can really start to list almost anything to trade on dYdX with leverage and with liquidity once we have these vaults. So we're really thinking of it as building towards potentially the holy grail of market listings. Can anything be tradable on dYdX? And we're pretty close to that. So I think that's something that we're excited about it.
Yeah, that's fantastic. And the concept of isolated margin makes a lot of sense, because once we start getting into the derivative world, you could have someone amass a huge derivatives position, but the spot market has a very small float. So you can move the spot market and get paid on the derivatives type of deal.
Right.
And so to kind of counterbalance sort of that risk, that makes a lot of sense to have the isolated margin. And then, yeah, the LP vaults are almost like a unlock for all the permissionless markets, because I imagine that traditional market makers, before they want to market make on a small coin, it has to sort of be worth it to them. There needs to be enough volume and spreads to be collected and things like that. Whereas now you essentially just solve that problem for derivatives, just like Uniswap solved it for spot. So that's really interesting. One of the other things I read on your roadmap for V4 is just the core improvements in terms of like connections via C++ and Rust and Go. What's the idea behind that? Is that more to attract a high frequency clientele, or is it something else?
Yeah, that's mostly for HFT firms or programmatic traders generally. And just having clients available in different languages, I think, is something that a lot of traders do find really valuable. It is a little more complicated to connect to a decentralized exchange than a centralized one. So just abstracting a lot of that complexity in the clients we found to be really helpful. So that's a big part of it. There are a lot of core performance improvements going on the chain right now. A little technical, but there are things that we're developing, like different ways to stream data directly off the nodes, which are really helpful for programmatic traders. And then just generally trying to get the latency and experience generally for LPs and programmatic traders to be as close to a centralized exchange and as performant as possible. It's a hard thing to do, actually, because the technology is pretty novel, but I think is something that we will just continuously improve.
And does building on a Cosmos SDK and essentially creating your own app chain, does that help unlock some of that, or is that sort of independent?
I would say it unlocks some of it because it gives us a ton of control over what we're building. We're developing the entire stack. If we were just developing a smart contract on Ethereum or some other L2, then we would be beholden to whatever the infrastructure tools for that network were. And those may improve as well, but we don't have as much control over it. So with this, we're developing the node software itself and everything in between, from the index layer to the front ends. And that really just means we can put in whatever is best at every level. And I think that's something you see generally as products evolve, either in crypto or beyond, is as the product becomes more mature, generally it will become more vertically integrated with whatever infrastructure it's built on. And this is the core reason we can just build something that's really tailor-made for this use case of trading.
Yeah, that's fantastic. And I imagine, having high frequency traders come into this space actually really helps sort of the costs and the spreads for takers. One of the things that probably happens is that there's probably flows on dYdX that are not mimicked elsewhere, say on Binance, and you have sort of different prices in terms of funding and things like that. Is that something that pops up sometime? Is the funding independent of CeFi exchanges?
Certainly, yeah. And generally that's true for DeFi in general. I think there is a little more dislocation on dYdX than you would see normally on a centralized exchange. As dYdX has become more mature, that's stabilized a bit. And there's positives, negatives to that. That does lead to a good amount of arbitrage opportunities, which leads to volume, which leads to more liquidity for all users. So yeah, generally it's something that we track and exists on dYdX.
Cool. So obviously dYdX is a super exciting project. You guys actually have a token out there in the space. Can we maybe just touch a little bit around the token? I know that in August of 2021, you guys did an airdrop. Why did you decide to do an airdrop as opposed to another method of launching a token? And what is the tokenomics and utility behind the token?
Yeah, so the dYdX token, as you mentioned, was launched by the dYdX Foundation back in 2021 now. And effectively, that was distributed in two ways. So first of all, through an airdrop, as you say, retroactively to users who had used the dYdX protocol. And then on an ongoing basis, effectively through LP rewards and trading rewards to users of the product itself. And that's something that continues on the dYdX chain to this day. So right now there's two incentive programs that are operated by the community and the foundation generally. The first of which is trading rewards. So as you trade on dYdX, then everybody who does that earns dYdX tokens proportional to the amount of fees that they pay to the protocol. So it's effectively a rebates basically that you're getting as you're trading on the platform. And then the second program that's operated by Chaos Labs right now is the launch incentives program, which effectively that's more similar to what a lot of protocols are doing with points. So just as you use the product, generally you'll earn points. And then on a, I think, bi-monthly basis, there will be dYdX tokens that are distributed for using the product. And I think just generally, a lot of products in DeFi have found really good growth through using these token incentives. So that's something that the community is deemed as important for the dYdX chain going forwards as well.
Oh, fantastic. So usually I like to wrap up with a couple questions. One is, what do you like to do on your spare time? And then the other one is, do you have any favorite books that you read along the way? But before I jump to that question, as an options trader, options are always top of my mind. Does dYdX have any plans to ever expand out into options derivatives?
So it's something I've been thinking about for a while. Right now, we don't have any firm plans to do that just because I think there's quite a lot for us to continue doing with perps.
Hmm.
And I also think the crypto market infrastructure is pretty different than in traditional finance, where really, obviously, perps have become very dominant. And I think that's going to continue to be the case for a while. They're just a product that is really optimal for retail, sophisticated retail, but still retail to be able to trade with leverage. So right now we don't have any firm plans to do that. We're more focused on the number of markets, how markets can be listed. Potentially in a year or two, it could be something that we consider if the market is there, but not right now.
Cool. So I'm sure you're a busy guy. I don't know if you ever get time off, but when you do, what do you like to do outside of work?
I do, yeah. And I recently moved to New York City, where most of the dYdX core team is based. So nothing crazy, but yeah, I like going to a lot of concerts, some EDM, that sort of stuff. And on the book side, if you're going to ask me about that next,
Hmm.
yeah, I've been reading a lot of interesting stuff recently. Probably my most favorite one is Siddhartha. It's a more kind of spiritual book,
Oh,
just
cool.
about a journey of enlightenment. So maybe that'll give you a little bit of insight into some of the stuff on my mind right now. But
Yeah.
that's started to become more interesting to me too.
Oh, that's fantastic. Well, Antonio, thank you so much for coming on the podcast. It's an honor. I'm really happy to have the chance to explore dYdX with you and hear about your V4 roadmap and share it with all the listeners. So thanks again.
Thanks so much for having me.
Absolutely. See you next time.